Right, everyone comfortably seated, both up here and in the audience. Well, welcome to our session. It's an interesting session because we're looking at disruption and innovation, and they're always kind of different sides of the same coin. You don't get innovation without disruption, and often innovation drives disruption. So we'll dive into that. It is an international perspective, but I think where we can, we'll probably try and make it as relevant for the South African market as well. We're operating in a very interesting environment at the moment. We talked about volatility at the start of the day, and hopefully, certainly on the sell side, that's driven some flow and some revenue, and potentially opportunities on the buy side as well. But we've seen very volatile markets. Certainly over the last 12 months or so, we've seen structural change, and at the same time, we're operating in a much more wired, real-time, data-intensive world. We're seeing innovative new technology coming to play in a meaningful way in our market, such as blockchain and AI, and perhaps we'll touch on that. And yeah, really, I think today we want to cover a few topics. Certainly, starting with volatility and some of the impacts that structural change is making on our market, extended trading hours, fragmentation, some of the impacts on retail. So quite a lot to cover. So I'll ask the panelists to keep the answers reasonably punchy, and we keep it moving along. But before we start that, I'd like everyone to just introduce themselves, maybe say who you are, and then perhaps your key focus at the moment, or what's keeping you awake at night. That would be great.
Great.
Alicia.
Thank you. Right, so I'm the Director of Post-Trade Services at the JSE. I also look after all of clearing, settlement, risk management. And after the previous panel, I'm very hopeful that next week my problems are going to include figuring out how we implement non-ZAR listings and collateral. So yeah, we have a number of very large transformational projects underway in the South African landscape at the moment, which I think speaks very well to this topic of how we tackle that with the new tools and so on available to us.
Paul.
Thank you, Mike. I'm Paul Humphrey. I'm the CEO of BMLL. We're, I would like to think, a leading data science and analytics company. I come from a banking, broking, and an exchange background, so I wasn't born a data scientist. That's the area I now find myself in. And I guess I wouldn't say we're keeping us up at night, but certainly keeping us busy is making data available to our clients so that they can understand these markets. The data is getting bigger by the day. One of our investors is Optiva, and they believe that global volumes will double in the next 2 to 3 years, and that will continue at that rate. The scale of the data that people need to understand those markets is becoming more difficult to grapple with on a daily basis, and we're looking to make that easier for our clients so that they can understand.
Yeah, it's a big challenge. I think we're going to come back to that later, so thanks, Paul. Cyril, over to you.
Yes, Cyril Bosch. So I am responsible for a product focusing on the EMEA region at FTSE Russell. So really focusing on helping our clients develop new and innovative products to really weather some of this volatility that we'll discuss a bit later. And my background, so I'm a fund manager by training. So for the last 15 or 20 years, I've worked at various hedge funds and pension funds in the UK. And also for the last 3 or 4 years before I joined FTSE, I was at a fintech startup, really building a kind of mobile-first digital asset investment experience for UK retail customers, and really trying to implement like an AI-first approach into everything we did with that company. So keen to discuss that.
Brilliant. Thanks, Cyril. And Sal.
Thanks, Mike. Good afternoon, everyone. Sal Rodriguez. I look after execution services for Instinet, which is the equities execution business for the Nomura Group. So anything that touches sales trading, and everything in between, I'm responsible for. So delighted to be here. Thanks to the JSE for giving me the opportunity to be here and seeing lots of friends in the audience, and hopefully some new friends and acquaintances as the day evolves. And to answer what keeps me awake at night is the extra governance and ownership and the onerous nature of it with the volatility that we're just going to discuss in a few minutes.
Brilliant. So look, a very interesting all-star panel here with both some very complementary roles in their current role, but also some deep experience behind that. So I think we're going to have a good discussion today, hopefully. So Kathy did a brilliant setup session this morning to open the conference, super enjoyable. And I think a lot of the topics we're going to touch on and perhaps sort of hopefully dive a little bit more into them, because certainly lots of interesting things happening in the market, but not least volatility. So growing up in financial services, volatility used to be quite episodic, right? It would come along every while, and then you go back to being, certainly when you sat on a desk, pretty bored for a lot of the time, and then it got crazy. But it almost seems like the new norm now. So Sal, you're sitting on the sharp end in an execution desk. So do you think that's right? Is volatility the new norm? Is this the phase we're going through, or is there sort of structural change?
It really is, and I think Kathy was alluding to me when she said the old guard. I'm definitely part of that group. When I started in the business, a 1% move was shock horror, hold the front page, what's going on. Now we saw some M&A activity in the UK the other day, an asset manager bidding for someone else, 30% in a heartbeat. So I think, you're only one Truth Social post away from disaster and carnage, which, by the way, as a flow business is great because we're agnostic to up or down. We just want to be in the flow. But that brings with it the point I made earlier around being kept awake at night: governance, limits, checks, gateway, how we're connecting to the different exchanges, what are our limits with our clients, are we doing all the right things. So definitely volatility is here and probably here to stay. If you look at the world order, actually, if you go back a few weeks, Davos, the main topic in Davos was going to be something else, but something called Greenland suddenly cropped up. And then that was, I think it was going to be AI, but Greenland cropped up, and guess what? The focus was on that. So I think the world order is changing. The traditional institutions that kept order in check, the UN, NATO, WTO, what does that mean now, right? So we need to navigate, and what does it mean tomorrow, then what would it mean today? I think that changes on a daily basis now. So I think very much here to stay.
Yeah, it was interesting actually. I was speaking to a friend earlier today who works in the commodities market, and he was saying volatility actually is keeping some traders away and investors away from the market, actually, certainly in that asset class. Obviously, we're primarily focused on equities today. I mean, Paul, I don't know, do you have a view when is there too much volatility and it keeps investors on the sideline versus actually, no, it's just that's opportunity and people are diving in?
Well, in previous lives, when I was managing risk, I didn't like volatility. When I was a broker, I loved it. As long as things moved, volatility was our friend. I think these days, volatility, if you leave aside all the risk parts and all the rest that I don't have to manage these days, it just brings more complexity to the marketplace. Which, of course, as firms are increasing in their sophistication levels, quite literally by the day, almost by the hour these days, grappling with the information is a challenge. One thing's for sure, the more they understand the market microstructure of the venues they're trading on, the more they trade on them. That we've seen real evidence of that. So I guess when it comes to commenting on volatility, we know our place in the marketplace. We know what we need to do for that. And I'm very grateful that I'm not managing risk anymore these days. I think I'd lose what little hair I've got left. And I have got some.
We go to the same hairdresser.
It's not all on your chair.
Exactly.
So it's interesting, right? Because we think about it from an opportunity perspective, is that certainly from a trading perspective, but obviously volatility can mean massive volume, can mean spikes in data, spikes in trade. That stresses infrastructure both on the front and back office. So maybe Alicia, turning to you from an exchange perspective, volatility good?
Well, of course. I mean, volatility, if I look at it from the full value chain perspective, is something that we thrive on. I think where we are moving toward is a much better ability to cope with it. As we build out our data sets, as we connect data sets from previously disparate sources, I think, our ability to interpret that data quickly and our ability to respond as quickly as possible is really what it's about. So, you know, I think if we look at technological advances in terms of applications, AI tooling, data consolidation, we're in a much better position now than obviously we were even 5 years ago, let alone 15 or 20 years ago. So, you know, I think managing volatility for all of us is just becoming more and more part of our fabric. And, you know, we have a little joke at the JSE when we're feeling very sorry for ourselves. We say, you know, the days of the single black swan are long gone. There's a flock of black swans that hit you, and it's persistent. But, you know, if I look at, for example, the performance of our market, going back 5 or 6 years pre-COVID, and how well we have actually been able to get through that really well, notwithstanding a few bruises here and there, I think is testament to the progress that we are making in terms of the tooling and transparency. There's obviously a long way to still go. There will always be work to be done in this space. But I think, you know, you speak about opportunity. One often thinks about opportunity from volatility in the commercial sense. You know, how do I make more money off more trades? As a risk practitioner myself, I do think about the opportunity that I now have in having more data and better tooling available to me to actually be able to foster safer markets. That's a very valuable opportunity to me.
I think you make an interesting point. We were talking earlier on about Knight Capital, if you remember that, which was this sort of high-flying firm for a while till it all came crashing down. And I think, you know, electronic markets have sort of, you know, exacerbated risk, and certainly in the earlier years, but I do think that infrastructure has become much more robust. And certainly that's on the minds of the regulators. You see in UK, Europe now with the DORA regulation, which is about infrastructure robustness. So I think, you know, that move to electronic markets wasn't necessarily plain sailing. There were bumps along the way, but I think it is robust now, and it has, you know, I haven't read about too many instances where the volatility has really challenged some of the infrastructure there over the last 12, 18 months. But I mean, perhaps, Cyril, from a buy-side perspective, I'd be interested, you know, what does this mean anything when you look at things like portfolio construction or the execution challenge from buy-side, or, you know, benchmarking against indices? When you have very volatile markets, is that an impact, or is that just BAU?
So one thing that I've seen, and I've only been at FTSE for about 3 or 4 months now, so I've been there for quite a short period of time, but we've got a very good view of what the global asset managers are doing, because we help them with a lot of research, with a lot of simulation and product innovation and development. So what we've seen pretty much in real time play out is how people and asset managers across the world are responding to this challenge. How are they responding to this kind of like volatility regime that is probably going to stick around for a lot longer? So we've seen how they've shifted into alternative weighting schemes in global benchmarks. We've seen how they've moved away from concentrated US, you know, high valuation, how they've really rotated out of that growth trade into more value, away from developed markets, perhaps into more emerging markets. So having seen that, we can see that people are responding, and they're responding very quickly. Both on the equity side, but especially multi-asset. So people, I think, from 2022 have had a really tough experience, because stocks and bonds had a very, very difficult year in 2022. So there was obviously that correlation structure that people kind of relied on for a very long period of time, where bonds will bail you out if things start going wrong. But so we can see a lot of people now trying to build more resilient portfolios, multi-asset, but beyond that traditional 60-40. So.
Yeah, that's super interesting.
I would just add that to the volatility point, we have to embrace it, because it's there. It's about how you react to it, how you adjust, how your systems cope with it. And Alicia made a great point around the data bit and the infrastructure bit. So I'm not a scientist, by the way, but Moore's law, I think, suggests that data doubles every 2 years, so that exponentially goes one way. And so people like me and firms like ours have to continue to invest in platforms and infrastructure that remain robust, that maintain orderly markets, that do what they say on the tin, because the last thing we want is, one, to disrupt markets, but also to give our clients a bad experience. So that's always happening in the background. You know, people that use our stuff, hit a button, it works. But there's a whole layer behind it that requires investment in infrastructure, technology, and the data that goes through. And this year, just for our US business, we've had our top 5 all-time volume days in terms of messaging in the system. That's in the billions of messages. So to be able to cope all time, to be able to cope with that, you know, you need a certain robustness to the platform.
Yeah, I think it's well. I think what we do, we'll come on to that, Paul, because I want to get a bit deeper that in a minute, because I think when you get volume of data like that and how you bring all that to data, it's all very well talking about new tools and everything, but you kind of got to get the data right first. But just wanted to sort of, as a bit of a segue from looking at volatility, dive into the sort of market structure. It's quite interesting when you talk about sort of market structure and in this case, for this panel, we were going to touch on fragmentation. When people talk about fragmentation, obviously, you know, in a market like South Africa, you might say, oh, it's sort of lit market, it's JSE and A2X, but actually liquidity fragmentation goes way beyond that. It's lit and dark, bilateral trading, all sorts of things going on. So, yeah, I wanted to touch on, and maybe Paul, you know, particularly because you get to see all the data from a liquidity landscape perspective, what's fragmentation, you know, how was the markets fragmented over the last few years? What does total addressable liquidity look like? You know, how is that picture moving around us?
Well, first of all, when I think it comes to fragmentation, I think the genie is out the bottle and you're not going to put it back. Yeah. So you look at markets around the world and the plethora of different venues, you know, look at the United States, you know, they had new exchanges popping up during COVID and since COVID, and the amount of ATSs. So I think that genie is out the bottle. Key thing is what you mentioned, is understanding what liquidity is addressable to you. And it may not be that the amount of volume in the market is indeed addressable to you, especially when you're looking at venues that you have to be accepted on. In many cases, different, of course, you know, fair and open marketplaces, but the rise of SIs, the rise of ATSs, the rise of MTS, of course, where you can, it's not a given that you can become a member of that. So what is the scale of the liquidity in the marketplace, and how much of that is addressable to you really does influence the decisions the one puts on the market. That's one of the biggest use cases around us. I have to say, going back to your infrastructure point, when more often than not I find myself, you know, when you see news events and things that have happened during the day, I do think the industry should give itself a little bit of a pat on the back, actually, because I think a lot of what we see come out in the press, I often look at the market on the course of that day and I think, well, were the markets asleep here? Because didn't they read what came out in the press? Yeah, the market just got on with it.
Yeah.
Volumes increased, everything stayed, you know, it was operational move, and there wasn't ugly gaps and spikes and everything. There was volume for sure, but the market coped.
And that's not always been the case over our careers, right?
Absolutely not. So, no.
Yeah. No, interesting. And I mean, and Sal, coming back to the fragmentation point, I mean, you know, as an execution broker, and certainly in Europe, sort of post all the sort of, you know, MiFID rules, what kind of challenges does that create for you to provide access to all those different types of liquidity? And, you know, it didn't seem so long ago with sort of MiFID that, you know, regulators thought dark bad, lit good. But I think that view's kind of evolved since then, particularly for large trades on the buy side. Yeah.
There might be one or two challenges, yeah. So MiFID back in 2007 introduced concepts of transparency, competition, got rid of broker crossing networks, introduced MTFs, the concepts of best execution. MiFID 2 in 2018 talks about unbundling, venues, and kind of gave HFT a different name, systematic internalizers, or ELP providers from an SI perspective. Then we had a little thing called Brexit in the middle of all that, which then was...
That's a breeze.
I'll keep the politics to one side, but it just added another layer of complexity. So that means in a lot of cases, you've got a venue that is the UK venue, then you've got the EU venue, and so that's just mushroomed. And there's more coming, because a lot of the US venues and ATSs and venues are coming to Europe. So think of Intelligent Cross, PureStream, One Kronos, all those guys. And it was interesting at the International Trader Forum last September, I saw more than I had ever seen in my career of those US participants present. So they're coming, and they do a good job on us, the brokers, with the asset manager, because they sell the dream and they create this a narrative around you should do this, you should. But of course, we then have to build it, deploy it, etc. So I think the requirement to navigate that complexity goes back to one of the original points around investment in technology, smart order routing. No two smart order routers are the same. You get into really quantity stuff, probability of fill. Where do I get creating that heat map, which I think Paul can talk about as well. But it's not easy, and those that do well, right? And it's very clear that those that don't invest or continue to invest will struggle. Obviously, we see some fragmentation in this country, and it's a very well-established concept in Europe, but it will continue. It will continue to fragment because more players are coming and more people have different order types, and even the ELPs have different streams. So they create bilateral streams with the brokers. I need a feed for that thing. I need another feed for the same broker, but for a different type of liquidity. So you could have multiple feeds for that. So again, that messaging rate, that infrastructure is key.
Does anyone have a view on, when is there too much fragmentation? I mean, it was interesting going through the whole post-MiFID. If you think there'll be names that people just don't even remember, like Burgundy. Who remembers Burgundy, right? Turquoise got siphoned up by London Stock Exchange. So there was quite, some fragmentation. There's a bit of reconsolidation, and then, as you're saying, actually interesting at the moment, there is a wave coming over from the States, like One Kronos and so on. So, I guess one has to be careful. Like, are you creating better quality liquidity, growing liquidity, and in making the market more attractive, or are you just spreading liquidity more thinly? And perhaps something we come on to Alicia is actually driving costs, because I think one of the things that never got talked about during MiFID enough, certainly in UK EU, was the costs of participation. And you started to touch on it a bit, Sarah, with you've got to connect to the venues, you've got to connect to the market data, you've got to bring it all together. It's not for free. So you might be getting slightly better spreads. So there is, it's not. There's a debate as to how much is it driving the attractiveness of the market. When does it become actually too much? Hasn't really improved the scenarios, driving up costs.
Yeah, I've got some views on that. I think, as you said, fragmentation can either create new liquidity or it can just dilute the liquidity you already have. And it comes at a very high cost. I think, unfortunately, many of us think about the cost to our own organizations, but if you look holistically at the cost across the market, individual organizations need to connect, they need to have, dashboards and data across all the venues that they're trading. But regulators need transparency. We need to do post-trade risk management across those venues in a siloed way, but somehow bring it together. We need to worry about indices. How do we get decent indices out that actually reflect activity across all of them? That's a market-wide issue, not an individual organizational issue. We know that consolidated tapes are something that are tricky and onerous to build. So I think the issue around the cost-benefit of fragmentation versus the costs associated with it are difficult to get one's head around, because you don't bear all the costs. The market as a whole bears the cost. So, I think as an emerging market, though, looking at where we see much greater levels of fragmentation in other jurisdictions. There's many lessons for us to learn there, and I would just appeal to all of our practitioners to think about what we can preempt in terms of building out that infrastructure set. I think building out that infrastructure set doesn't only address the fragmentation issue, it addresses some other issues as well, so we can get some bang for our buck there. But I think it's something that we can't avoid, so let's be let's be thoughtful about how we build that out.
Yeah, good point. And actually, Cyril Lissi brought up the point of index calculation, and so I'd be interested in your perspective on that sort of benchmarking, and particularly like how you view taking into account all addressable liquidity that might be, as I said, some of it might be lit, some of it might be dark, primary venue versus ATSs. How does that impact your world at FTSE Russell?
So it's a good question. So our view is that fragmentation is good because it's policy-enabled competition, and that should be good. But if it's implemented in the right way, if transparency and the cost of data kind of scales with the amount of fragmentation. So how we deal with that at FTSE, obviously, we really pride ourselves on like governance and transparency. And with increasing fragmentation, we now need to get a lot of additional pricing data. We need to get a lot of additional liquidity data from all across the market. And that's something that directly impacts the way we obviously calculate our indices, because most of our indices would have very strict investability constraints.
Yeah.
And obviously, if you don't have a very, very good view across the market of all the addressable liquidity, the way that you then implement those constraints into your index is not going to be consistent. So we really do focus on that to make sure we get all the best data.
And presumably that becomes a moving target as the market evolves. So
Exactly.
no rest for the wicked, right?
Yeah.
I think one of the unintended consequences of fragmentation is how it sucks up liquidity away from the primary markets, in the sense that, especially in Europe, where the cost of doing business is so high for a number of reasons. So if you're a broker, you look to internalize as much flow as you can to, one, save cost, obviously, but two, to give a better, in theory, outcome to your end client. And so you get into situations where the bigger brokers, the bigger banks, are internalizing huge amounts through their central risk books, through their systematic internalizers, and the public market becomes almost the last place, the place of last resort for the exhaust flows. That can create some toxicity, I guess, because it's the last bits of flow. So what are the unintended consequences of having too much fragmentation? In my experience, as we've alluded to already, it's quite pronounced.
I think fragmentation's fine when it brings a level of innovation with it. If it's fragmentation for fragmentation's sake, I just think it dilutes the pool. And I think a lot of the newer venues have come with different levels of innovation. And I think for some of our, certainly for our clients, some of our emerging exchange clients are able now to look at the whole of the US market, all the ATSs, look at the different order types and select, well, what ones are working well? How can I use those in my environment? And in many ways, some of the more esoteric exchanges are able to sort of skip the whole landline phase of making mistakes and go direct to mobile, right? And they can do that because the data's now available for them. I mean, you look in Europe, we're going to have a consolidated tape now. We are the validating historical source behind Euro CTP. Whether the tape or not is a good idea, the market wants it, the market will get it, and the regulators endorse it. Believing it will be the panacea to everything, however, well, you've only got to look 3,000 miles away across the pond. Did it reduce fragmentation? No, it sped it up, actually. When you look at the way that tape is arbitraged with the people out there trading those markets, it's become more complex, more trade types. So assuming it will be a panacea, I think is a mistake. And assuming in many ways for people it will reduce data costs as well. It won't. People will still buy the data direct from the venues, and they'll buy the consolidated tape because they'll need to see what the clients are looking at.
Yeah.
So, and all of those lessons are there to be seen playing out 3,000 miles away.
Yeah. No, so maybe one of those areas where being first isn't necessarily best, right? But
Unintended consequences.
well, unintended consequences, and I think you see that a lot through the sort of innovation and regulatory and market structural change in the market. But when you think you're on top of all of that, then the next thing that comes along is, oh, we're going to 24/5, 24/7 trading, which is kind of interesting, right? Because I guess even in traditional finance, we've lived with that with FX. So it's a kind of 24/5 market. Certainly, our digital bros have been introducing us to the wonderful world of 24/7, although that's primarily been a retail market. And actually, if you look at a lot of the technology behind the whole kind of wave one of crypto, it's been very it's not low latency, it's not high volume. A lot of it's internet, a lot of it's sort of retail focused, but that's changing pretty rapidly, and maybe touch on that later. But it seems to have momentum, certainly in the States. And I was speaking at a conference in Singapore in November, and it was interesting. It's popular in Asia, and then there's a venue called Blue Ocean that's sort of offering US stocks. But I don't know. Do people have views on? Is it a good thing? Do we need it? Is it largely a US-driven thing, and people who want to invest in? I think Kathy made the point earlier on that that's the big behemoth in our industry. Is such a big market that everyone wants to trade the US. But do we need 24/5 in other markets, in South Africa, for instance? Anyone?
Short answer is no, I guess. I mean, it wasn't long ago when there was a discussion in Europe, certainly around reducing market hours for a whole host of reasons, including inclusivity, diversity, etc. But that was poo-pooed, that was kicked into touch by a body. So that didn't get anywhere, and we've gone full circle to extending out. The world's largest and most successful market is open far less than we are in Europe, and it does very well, thank you very much. So as you said, the precedent is there for us to see across the water. And I think it's true to say that it's led by Asia retail, for sure. I think Blue Ocean and others are pushing aggressively. There was a time when Turquoise, I think you mentioned earlier, were actively trying to tap into the specifically South Korean market, because I guess they're techie savvy, it's all on their phones, and how they navigate the time zone difference from, I guess, Central Europe to the US. But there's a structure that exists already from 9 UK time, 9 a.m. UK time. The pre-market US is up and running, and it trades. You could trade. I mean, it's very liquid. So it's there. It's proven. It works. They have aftermarket as well. So I think we've heard it already a couple of times on previous panelists and in the press that the buy side, senior people at the buy side, are kind of lukewarm at best to it, in the sense that at 3 a.m. Where's the governance? Where's process? Where's the fat finger check? How do you know that's the right price? How do you justify that to your fund manager, et cetera, et cetera? So I think it comes with a lot of complexity, but the problem is that DTCC and others are kind of endorsing it. So the reality is it's just a question of time. It will come.
And do we think actually shortening settlement cycles is more important?
I think there's a very close link between those two things, because if you go to longer trading days, or even 24/5 or 24/7, but you've got like a T+2 or T+3, obviously massively increasing your unsettled risk. So I think those two things are very linked.
Yeah, there's an analogy that says, how do you open a 24/7 autobahn but only clear out the accidents every 3 days? So I think undoubtedly, even having real-time 24/7 with even T+1 is likely to throw up some of those challenges. Certainly not on the type of settlement cycles we're on here today. So, settlement is a big topic for us in South Africa at the moment in the equity market. It's something that we are most definitely debating the roadmap forward, but I definitely would agree that it is a precursor to going to 24/7. I just don't see how we would do it without it. And it makes me reflect on the new market, the markets that are 24/7, the crypto markets and so on. They've come in fresh. They've come in with a blank piece of paper to build the systems and the environments and the entire end-to-end operating model. So simpler from that perspective, where we are talking about institutional players, we're talking about existing operating models, legacy platforms across the value chain, not just at the financial market infrastructures, which need a lot of overhaul before we get to that. So is it something that's appropriate for an existing market, or is it something you build in parallel in a different way, perhaps through tokenization as an example?
What do we-
Might be a way to unlock some of that problem.
I mean, you would look, any venue operator will tell you a concentrated window, you'll see deeper liquidity, of course. That's not, but the genie is out the bottle on this one. Look, and also you've seen, there was an interesting report from Goldman on this, actually. There's a couple of things. One, don't underestimate the emergence of 5G around the world at the same time this is happening. So all of a sudden you can trade these markets from the locker room. The change in sports betting regulation as well has had a massive factor on this. People are saying, well, if I could do it on my phone in these particular markets, why can't I do it in the stocks that I want to trade with? You're seeing the rise in prediction markets. I think they become mainstream. I genuinely do. All of this is fueled because the underlying infrastructure is available and sitting in your pocket. So I don't think there's any way of reining it back.
Well, that's a good segue, Paul, and perhaps you want to carry on that theme, because we've only got a few minutes left, a couple of other topics I want to dive into, but that leads us nicely into the sort of data analytics, AI. Is the technology there? Is the infrastructure there? Is the data quality there for us to really deploy AI in a meaningful way? Are we starting to see that already, and where do we think that's going?
I think the quality of that data was formerly in the hands of only a handful of firms who invested in an army of quants to clean this data up, to make it usable. We and maybe others are making data of quality available. I've seen a paradigm shift in the last 3 to 6 months on the talk around AI, and it's about what people can do with the data. So the rush before was to get data into a usable state, and it's interesting, the difference between a data engineer and a quant. Two different things. Getting data ready and usable is an engineer's role. Understanding what to do with it is a quant's role. And I think over the last 2-3 years, we've seen those blend. AI will separate that completely. So we're involved in many more conversations with people telling us, real people from real firms, what they're building on top of the data. The data problem's been solved. And that normalization issue, why it does come down to a human issue of getting it right. If you get normalization 99% right, the sophisticated user cannot trust the data.
Yeah.
The minute they find an edge case you haven't solved for, it's, I need to normalize it myself.
Yeah.
I think now that data like ours and others is in a usable state, enabling great minds to work on that data, to tell stories around that data, I think is so much more easier today than it's ever been.
Yeah. I think that's right, and I think we're seeing easier access to data and democratization of some of these tools through AI. So perhaps, Cyril, from a retail investor perspective, there's some very interesting things happening in the market. That you look at some of the tools, some of the automated portfolios and stuff. Do you think that's going to change the retail investor world a lot? Is that going to drive more proactive participation?
Yes, so it's a bit of a nuanced answer, because with retail investing, and the FCA actually went and they did like a lot of research into this, 70 to 80% of all retail investors in the UK lose money on a rolling 12-month basis. So with all of these tools, we need to be very careful not to enable access, enable people to be able to be more trade more on a daily basis, and then have a significantly detriment impact to their wealth over the long term. But what I think AI can be useful in this space is because access is very good if it goes with education. If you can enable people to do the right things with their money over the long term. So I do think that AI can be used in areas like personalization at scale. You can personalize portfolios for individual investors, and you can also at the same time give them a lot of education on the behavioral aspect of investing, how not to fall into those pitfalls that is so
I don't feel so bad now you've said that statistic. I feel better now.
exactly.
No, I think that's a great answer actually. But just conscious of time, I think we've got like 2 minutes left. Is there any questions from the audience? Anyone wants to dive in? I know we're covering a quite broad set of topics here, but I can't see. I've got a spotlight in my face. I'll give you my name, rank, and number only. But. Okay.
Maybe I can just add a point on the AI. You know, the guys have been speaking about the sexy stuff that one can do in sort of trading strategies and so on. But you know, in the middle and back office environment, the applications for AI in terms of making some of the changes we need to make to our applications to deal with newer trading strategies, fragmentation, digital markets, whatever the case might be. I mean, there are enormous opportunities to not only bring about the changes that we need to keep up, but to actually take us to a new level of sophistication when it comes to risk management, oversight, surveillance, compliance monitoring, just to ensure the safety of the markets as the trading strategies and the globalization of the markets, you know, take flight. So I think that certainly is something that we are leveraging at the JSE to very good effect in the context of, for example, overhauling our legacy platforms and so on. And I think for many of the participants here today, surely that must be a very important part of their technology re-architecting tool set.
I think that's a super point actually, because I think there's a danger in the market that if AI is applied to trading strategies and algorithms but not applied to compliance and oversight, we're going to get ourselves in hot water pretty soon. So look, I'm going to steal 1 more minute 'cause time's up, but what I'd like to do is just go down the line and finish on a really positive note. It's all gone bright red, I'm going to be in trouble. But, and just say very quickly the one thing that you're most excited about in terms of market innovation over the next 12 plus months. I'll start with you.
Yeah, so I think just picking up where on my last point, we have a lot of transformational work lying ahead of us in South Africa across most of our markets. So that's quite exciting. It is scary, but I am looking forward to being able to leverage new technologies, data and tools to bring about those transformations as quickly and effectively as possible, and hopefully leapfrog, you know, wherever we can into something that's quite new and innovative.
Brilliant, thanks. Paul?
Quite simple. AI, get on board or get left behind. It's simple as that.
Or retire.
Yes, I mean, I have to completely agree. AI is probably the most exciting area for us at the moment as well.
Yeah. And Sal, you're not allowed to say AI. But
Well, actually, I was going to say AI and how we're going to implement it, not to trading, but in governance and back office and onboarding and all that kind of stuff. But actually, continue to take market share from those international brokers that couldn't be bothered to come here.
Boom. Great way to finish. But thank you very much for listening. I hope you enjoyed that. And thanks very much to the panelists for brilliant answers. Thank you, everyone.